Watch price very carefully, because what looks normal here is actually a setup. Right now, most traders think the market is going up. They feel confident. They start buying. But something else is happening behind the scenes. The market doesn't move randomly. It moves with intention. At this moment, traders believe they're right. But in reality, they're being positioned for a loss. If you don't understand this move, you become the liquidity. Now watch what happens next, because this is where the trap gets exposed. Now just stay focused on the price action, because everything you need is already on the chart. At first glance, this looks like a normal move, nothing special, just price going up. And this is exactly where most traders get comfortable. The market looks the safest right before it moves against you. Notice how price is slowly pushing higher, creating confidence, building belief. Traders start thinking, this is a strong move. But what they don't see is that the market is preparing something behind the scenes. Confidence in the market is often manufactured, not real. And this phase is where the trap is being built step by step. So don't just look at price. Understand what it's trying to make you believe. Now watch this move carefully, because this is where things start to shift. Price was moving up, building confidence, and suddenly something changes. We get a break in the flow, a shift in direction. The market always shows signs before it makes the real move. But here's the mistake most traders make. They ignore this shift and keep thinking the trend will continue. They see this as a small pullback, not realizing it's actually a warning. Smart money reacts to structure. Retail reacts to emotions. This moment right here is the first sign that the market is preparing for something bigger. Now bring your attention to the left side of the chart. I've marked this area as buy-side liquidity. You can see price forming highs at this level. This is where most traders place their stop losses, because to them, this looks like a strong structure. It looks clean. It looks reliable. It looks safe. So traders feel comfortable buying into the move and placing their stops just above these highs. But this is exactly how liquidity is created. The market needs these positions. It needs these stop losses to build volume. This is not a strong level. It's a target. What traders trust, the market is preparing to take. And once enough liquidity is built here, price doesn't respect this level. It moves through it with momentum. Now focus on this area where price starts reacting. I've marked this as the supply zone. You can see how the upward movement begins to slow down here. Price is no longer moving with the same strength. Momentum starts fading at this level. But from a retail perspective, everything still looks bullish. Traders believe this is just a pause before continuation. They expect price to keep pushing higher. And that's where the mistake happens. Because behind the scenes, selling pressure is entering. This is where smart money starts positioning. They are not buying at this level. They are distributing their positions. What looks like continuation to most traders is actually preparation for a reversal. And this is where the trap begins to build. Now pay attention to this small movement in price. I've marked this as minor inducement. At first, this looks like a normal continuation. Price pushes slightly higher. Nothing unusual from a retail perspective. Traders see this and feel the trend is still strong. They start entering buy positions again. Confidence begins to build slowly. But this move is not real strength. It's designed to pull more traders into the market. This is how liquidity gets added step by step. The market is not moving up to continue. It's moving up to attract more buyers. What looks like opportunity is actually preparation before the major move happens. The market creates this smaller trap first. Now take a closer look at this part of the chart. I've marked this as major inducement. This is where the move becomes very convincing. Price starts pushing higher with stronger momentum. It looks like a clear breakout is happening. From a retail perspective, this is the perfect entry. Traders feel confident and start entering aggressively. They believe the market will continue higher from here. This is where emotions take over logic. More buyers enter the market at this point. Liquidity builds rapidly in this area. But this is not real strength. This move is designed to trap the majority. The market is creating the illusion of continuation while actually preparing for reversal. All the positions get filled here, and once that happens, the market no longer needs to move higher. This is where the trap is fully completed. And right after this, the real move begins. Now shift your focus to the lower side of the chart. I've marked this area as sell-side liquidity. You can see these lows where price reacted before. This is where stop losses are resting. Traders who bought earlier place their exits here. From a retail perspective, this area doesn't get much attention because most traders are focused on the upside move. But this is the real objective of the market. Price is not just moving down randomly. It is being drawn toward this level. This is where the liquidity is sitting. What looks unimportant is actually the target. As price starts dropping, this is where traders begin to panic. Positions start closing. Stop losses get triggered. Liquidity gets collected from this area, and this is where the move completes. Everything that happened before was just to reach this level. Now, let's break down the execution part. I've marked this area as the execution zone. This is where I'm looking to enter the trade, not at the top and not during the trap, but after the market starts showing confirmation. Once price begins to shift direction and structure is respected, this is where the setup becomes clear. Most traders try to enter early. They guess the reversal and get trapped. But the real entry comes after confirmation, when the market reveals its intent. This is where risk becomes controlled and the trade becomes logical. You're not trying to catch the exact top, you're focusing on catching the move. This approach removes emotion and brings consistency to your trading. You are not predicting here, you are reacting to the market.